When China announced its decision to slash $690 billion in imports from the United States, the global economic community took notice. This wasn't just another round in the ongoing trade disputes, it was a declaration of economic independence. The scale of this reduction represents more than temporary trade tensions. It signals China's systematic dismantling of its economic dependencies on the United States, a strategic shift that's reshaping the global economic landscape. The transformation is perhaps most visible in agriculture, where China's pivot away from American farmers has fundamentally altered global trade flows. The numbers tell a stark story. U.S. soybean exports to China have plummeted from 40% of Chinese imports in 2016 to a mere 18% in 2024. In human terms, this translates to thousands of American farmers facing an uncertain future. States like Iowa and Nebraska, once confident in their position as China's breadbasket, now face a harsh new reality as farm bankruptcies surge and rural communities struggle to adapt. Meanwhile, Brazil has emerged as the primary beneficiary of this agricultural exodus. Brazilian soybean exports have surged to an unprecedented 3.7 billion bushels in 2023, dwarfing U.S. exports of 1.8 billion bushels. This shift represents more than twice the volume of U.S. shipments, marking a complete reversal of traditional trading patterns. Brazilian farmers have expanded production areas, modernized their infrastructure, and positioned themselves as China's primary agricultural partner. The ripple effects extend far beyond the farm gate. Agricultural machinery manufacturers report sharp declines in new equipment orders. Logistics companies that once thrived on U.S. China grain trade face declining revenues. Rural banks, heavily exposed to agricultural lending, report increasing stress in their loan portfolios. This isn't just about soybeans, it's about the systematic dismantling of decades-old trade relationships that once seemed unshakable. In the technology sector, China's response to U.S. pressure reveals an equally calculated approach. The Made in China 2025 initiative has transformed from ambitious plan to urgent imperative, particularly in the semiconductor industry. Chinese firms have accelerated their development of domestic chip manufacturing capabilities, with investments exceeding $150 billion in new semiconductor facilities. Companies like SMIC are rapidly advancing their manufacturing processes, while Huawei's HiSilicon continues pushing the boundaries of chip design despite international restrictions. As U.S. companies like Qualcomm and Micron watch their market access shrink, the impact reaches far beyond immediate revenue losses. American semiconductor firms have reported significant declines in Chinese orders, with some experiencing drops of up to 40% in their Chinese market share. This isn't just about market access, it's about China systematically reducing its dependence on U.S. technology while building its own technological ecosystem. The stakes in this technological decoupling couldn't be higher. Semiconductors represent the backbone of modern economies, powering everything from smartphones to military systems. China's investment in domestic chip production isn't just about market share, it's about strategic independence. Recent advancements in Chinese chip manufacturing, moving from 14 nanometer to 7 nanometer processes, demonstrate the rapid pace of technological catch-up. In the energy sector, the evidence of China's strategic pivot is equally compelling. The signing of a 30-year natural gas deal with Russia, valued at over $400 billion, fundamentally alters global energy flows. Coupled with a landmark $50 billion LNG agreement with Qatar, these moves demonstrate China's determination to diversify its energy sources. The scale of these commitments, extending decades into the future, shows China's confidence in its ability to reshape global energy markets. For U.S. energy companies, particularly those investing heavily in LNG export facilities, China's energy realignment represents a seismic shift. American LNG exporters had counted on Chinese demand to justify billions in new infrastructure investments. Now, projects along the U.S. Gulf Coast face uncertain futures as their expected primary customer increasingly turns elsewhere. China's Belt and Road Initiative serves as the framework for this comprehensive economic realignment. Trade with BRI countries has exploded, with total trade volume exceeding $1.9 trillion in 2023. Individual relationships tell an even more striking story. Brazil's trade with China surpassed $50 billion in 2023, while African nations have seen Chinese investment grow by 180% over the past 5 years. The initiative's scope is staggering. Chinese investments in port facilities from Piraeus to Gwadar, rail networks across Southeast Asia, and digital infrastructure throughout Africa create new trade corridors that bypass traditional U.S.-centered networks. Each project strengthens China's position while reducing U.S. influence in key regions. In Southeast Asia, the transformation is particularly evident. Countries that once balanced carefully between U.S. and Chinese influence increasingly tilt toward Beijing. Trade volumes tell the story. ASEAN-China trade reached $975 billion in 2023, more than double the region's trade with the United States. Infrastructure projects like the Pan-Asia Railway Network physically bind these economies closer to China. The financial architecture supporting this transformation is equally impressive. China's cross-border interbank payment system, or CIPS, now processes over $50 billion daily, reducing reliance on U.S.-dominated financial networks. The digital yuan's rapid development and deployment in cross-border trade further erodes U.S. financial leverage. These changes extend beyond traditional economic metrics. Chinese technical standards are increasingly adopted across developing markets, from 5G networks to high-speed rail systems. This technical influence creates long-term dependencies that will shape trade patterns for decades to come. For U.S. businesses, the implications are profound. Farmers face bankruptcy rates not seen since the 1980s farm crisis. Tech companies watch their market access evaporate as Chinese alternatives gain ground. Energy exporters scramble to find alternative buyers for capacity originally intended for Chinese markets. The $690 billion import reduction isn't just a number, it's a statement about the future of global trade. Each sector targeted by China represents another step toward economic independence from U.S. influence. The systematic nature of this decoupling suggests a carefully planned strategy rather than reactive measures. Looking ahead, the trajectory appears set. Chinese investments in domestic capabilities, from agricultural technology to semiconductor manufacturing, continue to accelerate. New trade relationships backed by substantial infrastructure investments create alternative economic networks that reduce U.S. leverage. For U.S. policymakers and business leaders, understanding this transformation isn't optional, it's essential for survival. The question isn't whether Chinese economic independence will continue to grow, but how rapidly and with what consequences for the existing global economic order. This shift represents more than just changing trade patterns, it's a fundamental realignment of global economic power. As China systematically reduces its economic exposure to the United States, it simultaneously builds new networks and relationships that could define the next century of global trade. Thank you for joining us for this analysis of China's strategic economic realignment. If you value this type of in-depth economic analysis, please support our channel by liking, sharing, and subscribing. Your engagement helps us continue providing detailed coverage of these crucial global economic developments. Join us next time as we explore more aspects of China's growing global influence and its implications for the world economy.